4 stocks on my watch list as potential buys this week. Like many of you, I try to put money on my portfolio on a weekly basis and try to find investments to park my cash in. So let's get started. And I want to say in today's episode, I'm going to take a closer look at 2 ETFs and 2 individual stocks. The first ETF might be one that might not surprise you, and this is going to be a semiconductor overall ETF. So there's 2 that I own in my portfolio. There's VanEck Semiconductor ETF, ticker SMH, and then there's Invesco Semiconductor ETF, ticker SOXQ. SMH is one that's been a lot longer. They have a lot more volume and they have a lot more assets under management. The reason I do like Invesco a little bit more right now is because it does have a cheaper fee. Unfortunately, though, it doesn't come with all those other pros that I just gave about SMH. Like I mentioned, I own both, but I tend to buy SOXQ a little bit more recently. Before we take a closer look at some other holdings, I want to kind of explain why I'm excited about the semiconductor market. Obviously, right now we are seeing this hype or these talks about artificial intelligence. And while I think that is great, there's other technologies, in my opinion, affecting this market. And just innovation itself is a huge driving force for semiconductors. I feel like a lot of investors get fearful of the semiconductor market because they believe it's very cyclical. And while it is very cyclical, I don't think the returns in stock prices are. I want to kind of compare VanEck Semiconductor ETF versus the SPY and the QQQ and kind of compare total returns, which includes fees, dividends, and other expenses as well, and kind of see how VanEck Semiconductor ETF has done against these major indexes. And we can see in the past 10 years, VanEck destroys it. The semiconductor ETF has provided 713% in the past 10 years to investors, where the Qs have done 390. So we can see, hey, semiconductor market is a beast. Now, if we kind of trickle down to the 5-year, we can see semiconductor ETF up 138%, while the Qs up only 85%. And I'm saying only because compared to the VanEck, it's no competition. If we take a closer look at 3-year, we can see the VanEck Semiconductor ETF up 153%, while the Qs are up only 76%. In the past year, all of them are negative in the past year, but the one less negative is VanEck, down only 6%, where the second less is the SPY, which is down only 10.77%. So we can see in all these time frames, VanEck Semiconductor ETF, a market that's supposedly very cyclical, continues to outperform the market. And we can see here year to date, VanEck Semiconductor ETF is up 23.35%, while the Qs are up roughly 14.7%. So for me, getting exposure into the semiconductor market is a no-brainer when we take a closer look at those historical values, right? And historical returns doesn't mean the same will happen in future returns, but like I mentioned, I do believe there's plenty of tailwinds in form of technology that the semiconductor market can benefit dramatically from. Again, semiconductor market, some of these holdings in some of these semiconductor ETFs, they do tend to have some of the high growth stocks like Nvidia. I do believe Nvidia, even though it's my #1 position, is one that might be overvalued in the short term. So it's one I don't feel comfortable investing in individually right now, even though it's my #1 position. But the other players do seem to be either fairly valued, maybe decreased in value compared to previous averages. So I would rather go more in an ETF approach right now, where in October, I think we were kind of discussing more of just individual stock approach. Now is more of a exposure to the overall market, because I do believe this is a better play for me in my portfolio. Before we go any further, I want to thank you for watching, and I need your help to reach my goal of 30,000 subscribers by the end of the year. So if you can do me a favor, hit that subscribe button and thumbs up. Also, if you want some fantastic insight into the semiconductor industry, join my other channel, Semiconductor Investing and More, where I use my electrical engineering background to break down the semiconductor market. Finally, I want to thank the Motley Fool for sponsoring this video, and check out fool.com/Jose for the 10 best stocks to buy now. With that link, you get a promotional offer for their subscription service. Now, let's continue with today's episode. All right, the second one is also going to be an ETF, and this is going to be in an industry that I feel doesn't get much attention right now and is getting a lot of negativity, and that is the video game industry. I'm just going to take a closer look at one ETF, Round Hill Video Games ETF, ticker NERD. Maybe not this ETF directly is one that I'm going to look at, but I think just the overall video game market is one I really need to kind of start adding to my portfolio. We can see this ETF down from its all-time highs is down roughly 62%. We do know that in COVID, we did see this rush in gaming. And even though users might be leaving the market or not spending as much time as they were before, the gaming industry is going to continue, especially with this overall emerging experiences and digital experiences that are a lot cheaper than some of the real life experiences out there. So video game industry, in my opinion, is completely overlooked. If we take a closer look at some of the top holdings from this ETF nerd, it can give us some great idea. I think one that's completely undervalued, and I hear this from a lot of investors in the gaming market, is Nintendo. So in this ETF, you're getting roughly 16.2% weighing, comes in that one player that many say is completely undervalued. Number two is Electronic Arts with roughly 10%. Another strong player in the gaming industry. Maybe things right now are looking weak, but EA, I don't see this going anywhere with their gaming, with their Star Wars partnerships, and with all the Sims that they have and all these other games out there, and their loot box style model that they have right now. Roblox is number three with roughly 7.4%. This might be the one that's considered like the Nvidia of semiconductors, where it might be overvalued at the moment. Maybe not the same growth opportunities as Nvidia, but it's the one that's kind of the outlier of the valuation in the in the gaming market. Number four is Take-Two Interactive with roughly 7%. So we can see the first four positions make up roughly 40% of this ETF. Again, the gaming market, in my opinion, is one that's overlooked right now. It's down a nice amount, and not many people are talking about it, and that usually means that, hey, it's time for me to take a closer look into this market. So let me know what you guys think about the first two ETFs. Now I want to go a little bit more on stock specific that I want to add into my portfolio. The first one's going to be Adobe, and the next two are going to be more software-based companies, SaaS-style or subscription-based companies. Adobe, in my opinion, I just did an earnings report yesterday, earlier this week. Earnings were amazing. I think Adobe is going to do great with this kind of creative market, imaginative market that we're in, and things like content creation, advertisement, and most importantly, because generative AI. So I do believe generative AI is going to do something amazing of making everybody, to some extent, some form of designer or some form of ad maker. And companies like Adobe are going to implement a lot of those technologies, and it's going to bring a whole new wave of users into their platform, right? Because right now, who uses Adobe? People that understand how to use Photoshop, people who understand how to use Premiere and all these other creative solutions. And imagine a world where it's a lot easier to design. It's a lot easier to get something impressive, right? Obviously, maybe those individuals who are pros at this can still do stuff amazing, but your average Joe with generative AI and this kind of AI technology will now have a use case for companies, for software like Adobe. We can see from its all-time highs right now, the stock from its 5-year high, the stock is down roughly 48%. But let's take a closer look at that financial health. Cash flow from operations in trailing 12 months, roughly 7.7 billion. Cash and short-term investments, roughly 5.6. Total long-term debt of roughly 3.6. So, in my opinion, financially stable. If we take a closer look at this company's reports, like I mentioned, they have three main segments. Adobe Creative Cloud, these are all those software applications that are used for the creative aspect. I'm personally not a subscriber, but with all the solutions coming out, this is one that I'm going to start to subscribe to. I want to say within the week or two. Next, we have Adobe with their Document Cloud, obviously their PDF and all these business solutions as well outside of the creative market is also doing pretty well. And then the Adobe Experience Cloud, which helps a lot with commerce, with analytics, with data insights. So another one for their kind of data platform. If we take a closer look, they do mention that they are seeing strong results and they had to even increase their upcoming guidance because of the huge kind of tailwinds that's entering in the creative market right now. We can see total revenue, even though it's not a high growth company, right? Generated 1.7 billion cash flow from operations this quarter, repurchased 5 million shares. They have roughly 5.2 billion in remaining performance obligations. A company I wouldn't be worried about, and I do believe it's going to get a lot of nice tailwinds from this generative AI push. So it's one not in my portfolio, but one I really, really want to add onto or add into my portfolio list. Now the fourth company, or the second stock, or the fourth one we're going to talk about here is Crowdstrike, ticker CRWD. Again, another one that's been beaten up right now. Obviously, valuations were probably crazy in 2021. Stock price down 51%. No point in price anchoring, but at market cap $31.4 billion. Let's take a closer look at financial health. But first, the cybersecurity market, in my opinion, still early innings. CrowdStrike with its AI platform is going to continue to dominate and grab a nice amount of players. I did an earnings report on them, so make sure to check out that video before as well. And one thing that I like about CrowdStrike and management is they're not scared of competition. They literally name drop companies like Microsoft and say, hey, yeah, they have some cool products, but they're nowhere near the level of our products. And I love that confidence from management. So I think CrowdStrike is a great player here in the cybersecurity space. Financial health looking great. Cash and short-term investments roughly 2.7 billion, so they have plenty of cash. Cash from operations in trailing 12 months of roughly 940 million, and they have total long-term debt of 740 million. So financially, nothing I would worry about. In the most recent earnings, record net new annual recurring revenue added of 222 million most recent quarter. Total ARR for the year grew 48% year over year to 2.56 billion. They're expecting that to even grow at strong double digits again for the next full year. Record cash flow from operations. They have plenty of cash, like we saw. They added numerous new amount of subscribers to their platform, which grew roughly 41% year over year. CrowdStrike module adoptions of 5 or more modules continue to grow. They continue to adopt new solutions and kind of provide new solutions for the market. And they are also seem to be poaching from other companies in this space. They added some executives from SentinelOne, and now they're part of their leadership team. So I think CrowdStrike is in a very emerging market. Obviously, might be a little bit highly overvalued, but it's one that I personally enjoy. Same with Adobe. So I hope you guys enjoyed today's episode. Take care. Have a good day, and see you next time.